Okay. Good morning, ladies and gentlemen, and welcome to our webinar today, which is on the Nigeria Tax Reforms 2025, with a focus on the individuals. Now, these Nigeria Tax Reforms 2025 are over quite a number of pages, and today we're going to delve into these significant changes as they affect individuals. There are two acts in play: the Nigeria Tax Act 2025, often called the NTA, and the Nigeria Tax Administration Act 2025, often called the NTAA. There are also two other acts that set up the administration of what was the Federal Revenue Service, and also the Joint Tax Board, and introduced a new subject of a tax ombud, which would be helpful. Now, these reforms are effective from the 1st of January 2026, and their aim is to modernize and improve the Nigerian tax system. However, they also bring a range of complexities and some dramatic changes for individuals. So they cover hundreds of pages, different tax types, and we've tried to settle for a few of the issues that we believe will resonate widely with individuals as we continue to study and unpack the detail. There are various things, and there were various versions until the latest version came out, which is the one that everybody's now working with. To discuss these impacts of these taxes on individuals, we have our two speakers.
Mark, you're muted.
Sorry. Our first speaker, Theo Emuwa, is a highly respected tax lawyer and a renowned expert with over 20 years of experience in the Nigeria tax legal market. And he has actually over 40 years of experience in the legal profession. He has been instrumental in advising both local and international persons on tax compliance and planning. His deep understanding of Nigeria tax laws and his ability to simplify complex tax issues make him a sought-after speaker and consultant. Theophilus is a senior partner with Alex, where he leads the firm's corporate and commercial practice. Our second speaker, although they will be speaking concurrently and at different times, is Russell Eastaugh. Russell brings over 40 years of unparalleled experience in African tax advisory. As a former tax partner in PwC Nigeria and Uganda, Russell has a distinguished career marked by his deep understanding of international and, very important for us, African tax matters, particularly in Nigeria and Uganda. He's a fellow of the Chartered Institute of Taxation of Nigeria, and he's renowned for his insightful analysis of tax developments across the whole of Africa and his practical approach to problem solving. Currently, he's the lead African advisory at Regan Van Rooy, and his extensive experience and stellar reputation make him an invaluable resource for our webinar today. So, having introduced both of our erudite speakers, we're now going to explore the changes of the new tax acts in Nigeria, and we encourage you to engage actively and share your thoughts and questions. You can do this most effectively by using the question and answer option, although we have found that people do also put things in the chat room. May we also remind people that you shouldn't be putting things that are not related to this webinar into the chat. Otherwise, we may have to take you out. For specific and detailed queries, our speakers will be more than happy to provide advice if you get in touch after the webinar, though some level of actionable advice may, as you will understand, attract a fee. The slides that we're going to be discussing, and we're not projecting them as we go along, we're exploring the subject, but the slides cover everything we're going to discuss, will be shared after the webinar to all registered attendees. So with those few words, I would invite, sorry about that. I would invite our speakers with a series of questions to discuss this subject. So start with you, perhaps Russell. These changes, quite wide-scale changes, have various impacts on different income groups. How do you expect that the new tax rates and the abolition of the minimum tax for individuals, how is that going to impact on low-income earners compared to high-income earners? And what are the potential socioeconomic implications of these changes? Over to you, Russell.
I'll make an attempt. Oh, I've got the echo now. I think the first thing is the change for the lower pay is very welcome. I've got an echo. It's a very welcome thing. So, yeah, they're abolishing the minimum tax. And I think at various times during the development of the new law, Taiwo Oyedele stood up. He's the chairman of the committee that wrote this. He stood up and said, look, we've got to stop taxing poverty. And I think that's entirely right. So I think this is a very welcome shift from taxing relatively poor people to trying to tax those who are better off and shifting the balance of taxation burden, certainly on the income tax side. So I think that's a very welcome development. It should lead to mass happiness. I'm sure it won't. People tend to forget that they've been relieved of a tax burden fairly quickly. And what we see in other countries, you do this thing just before an election, not halfway through the cycle. But there you go. People should be grateful for what they're getting. So I think that's a good start. I think it's going to cause massive change of focus in the various states. Perhaps not so much in Lagos, where they've been a bit more balanced in applying the Personal Income Tax Act, but in lots of states which were relying to a great extent on taxing the civil servants are now going to have to go hunt for where the money is, and not where the ease of collection is. So I think that's all that one. And the minimum tax, yeah, great. And there's a couple of other things, yeah, trying to stop taxing people on or below the minimum wage. For the better off, I think it causes quite a lot of changes. And yeah, one of the quirks of the old law, the current until the end of December, is this thing. Oh, the tax rate is what was it, 24%, and it's not, because of the exemption of 21% came automatically. So yeah, top tax rate was 19.2, declined to 19 or 18.96 above 20 million. Now, if you're earning, now it's going up to 25%, and if you're earning just a little bit more than 18 million a year, then you're going to be paying somewhat more tax than under the old regime. So that probably won't be so welcome. I think the bigger shift is probably including more income, more foreign income, bringing capital gains into the system at the income tax rate, your marginal rates. These are all things that are going to cause some problems. And yeah, I think people are going to, those who are going to be affected need to start thinking, what's it going to do to me and what can I do to mitigate it, and use the window of opportunity between now and end of December to try to do that. That's a time that will go quite quickly. So probably it's something that people need to get on with. And why do I see a window of opportunity? The effective date for the Nigerian Tax Act is 1 January 2026. The effective date for the Administration Act is a bit uncertain. It could be the 1 January 2026, which is what the government have said verbally it is. But actually, if you look at the bill, the Act rather, it says 1 Jan 2025, the version I saw, and the gazetted date was 26th of June. So it may already be in force. But you've still got the time before the new tax laws, the Act itself, take effect. I don't know if Theo's got any additional comments, but that would be my stab at the question.
Yes, I agree with Russell. In terms of state revenues, those who have been relying mainly on the civil servants for IGR, PAYE will now have to look elsewhere, and perhaps that's why many states, resisted the proposed changes to the rate of tax for companies, because they get a share of that, and they also resisted the way VAT was going to be distributed, and insisted that there should be at least 50% being distributed on the basis of equality, as opposed to doing most of it on the basis of derivation, which again would disenfranchise many of those states. So we can see how the proposals, on the one hand, they look nice as a tax a policy thing, but when you now get down to the effects of it, you can see why the politicians and the economists in different parts of the country would have differences of opinion. So Lagos and River State might be happy, with those changes. Some of the states elsewhere might say, no, this is going to deprive us of the money we need to run our business. So that's certainly an issue they will have to address, because even the VAT collection, given the changes that have been made with regard to input VAT being wider in scope, may lead to a bit less money coming in there. So those states still have to do some homework to get their internally generated revenue up. But I agree that with Russell's comments.
Okay, that's very insightful. So basically, the poorer will be taken out of the net. The richer will have to pay a little bit more. It's not really that much more. Well, it depends on whether you're the richer, I guess. But there will be definite impacts, and we'll circle back to the capital gains changes, which are going to be very impactful. One of the key things that you're pointing out and that everybody needs to be aware of is that basically the books have been torn up and put back together again in a completely different way. So we're going to have to unlearn. I was chatting earlier and explaining how I was having to teach some AI tools how to read the new laws. So you'd have to stop the way you think and restart the way you think. For state boards of internal revenue, it'll be, you can't go chasing after all the little people anymore. You've got to get on your hats and become a proper tax inspector and go after the ones that are worthwhile. It suggests with the inclusion of Section 29 in the new taxes Act, Nigerian Tax Act, that provides for presumptive tax, that there will be a lot more use of presumptive tax across the piece in order to tax the medium taxpayers. The exemptions from tax for companies is standing at 100 million. Sorry, at 100 million. For businesses, it's the other way around. For businesses, it's at 100 million. For companies, it's at 50 million. So some of these differences in thresholds may create arbitrage opportunities, but will also mean that the educated tax inspector will have a lot more teeth when he comes to bite. Now, alongside these changes to the amounts of money that they will have to pay, the residency rules under the new Taxes Act have also changed for individuals and their related commercial interests. So how do these rules define tax residency, residency for tax purposes, and what are the implications for individuals who split their time between Nigeria and other countries, or who may actually be Nigerians who live in other countries, but because of their connection to Nigeria, they are Nigerian? Shall we start with Theo?
Yeah. Okay. Well, on that point, there are two different classes of people to look at. There are those who are in employment or who are employees, and then there are those who are, shall we say, self-employed, consultants, business, freelancers, what have you. Now, if you are in employment, let me start with how residency has been redefined. One of the major things is that domicile in Nigeria has now been included as a criteria. Now, domicile is one of those words that can be a bit difficult to define, to pin down. It's a bit amorphous. It's more about what you think rather than what you do. So you can declare that my domicile is so place. There was a famous incident with the wife of the former British Prime Minister, who was living with her husband, the Prime Minister, in the UK, or I think he was then Finance Minister, while she was claiming domicile in India because she had significant Indian income that she wanted to insulate from UK taxes. And that was perfectly legal. but it became a PR nightmare when the public got to know about it. They said, how can this woman who's getting all these millions not pay tax in the UK? She claims non-domicile, but she's living with her husband, who's our minister. I mean, she was well within her rights, but she then had to do the PR bit and say, okay, from now on I'll pay something. So domicile is one of those things where that you can argue about. They put it in, and I can see how it's going to create a bit of debate between the tax authorities and individuals, particularly individuals who have significant income. Then there's another element that's been included, which is having a permanent place available for domestic use in Nigeria. So now most of us have family homes in Nigeria. Some have family homes in the village. Those homes are available for domestic use. So I live in America, but I come home every Christmas, spend 2 weeks, and I go back. If you look at this, it might make me tax resident in Nigeria. I don't know if that was the intention, but again, another area where quite a bit of debate is likely to occur. A place of habitual abode is another, criteria. Now, substantial economic and immediate family ties in Nigeria. Again, these are things which many Nigerians have all these things, even though they physically don't live in Nigeria. And I'm wondering how it's going to be dealt with, come January next year. Because many people have families in Nigeria, even though they've lived in America forever. They have homes here, even though they never intend. In fact, the joke is that many people in the eastern part of Nigeria have homes that are well built, nicely built, but they spend 2 weeks in a year in those homes, and the rest of the year is empty. So how those people will be caught is, what I wonder. If you live in Nigeria for more than half a year, well, that's always been there. So this definition is meant to create a bigger, scope of people to be caught, but it's going to lead to some quite a bit of debate. Quite a bit of debate. Yeah.
Yeah. I think
Russell?
just building on that, I think you're right. It's going to cause a lot of debate. Some of it's probably going to go to legal debate rather than just change of correspondence, because it is a bit slippery. I think I'd add on to that, there's a bit of a gap between the definition of resident and the definition of non-resident. They're not mirror images. There's a lot more words in non-resident, which is a bit peculiar. But I guess somebody's thinking if you're not non-resident, you must be resident.
Exactly.
One of the debates I think is going to come. Now, I think on that, and just building on Theo's comments, I think there may have to be a degree of realism in it. If I'm caught in that definition of Nigerian resident because I got a house which I spend 2 weeks a year and I'm working in the States or the UK, is there any money for Nigeria to collect? Because the double tax credit system has been vastly improved, and you will now get a credit against your Nigerian tax from a foreign tax. I was thinking when we were talking about the tax rates earlier on, I'd love to pay 25% because I probably pay about 50 if I take my national insurance contributions into it in the UK, and therefore there'd be a lot of effort, and the government in Nigeria would get no money out of the effort because I'd fully utilised the foreign tax to set off against the Nigerian one. That does create a lot of effort and record keeping, but that's the way of it. I think a bit like Theo, I saw 2 or probably 3 groups of people. There's the expats, people who are foreigners living in Nigeria, and I think there's some elements of bad news here. Some will have double tax agreement protection, some won't. Some will suddenly see they're now expected, once they've been there a few months, to start declaring all their foreign income and paying tax on it in Nigeria, which is perhaps not what they really want, may make it a less attractive place to be sent to as part of your career. That's the one. Then you got the Nigerian diaspora. How are they going to prevent themselves paying tax in Nigeria? Yeah, I've mentioned if you're in the UK or USA, if you're in Dubai as a very popular destination, the personal income tax rate is 0, so you're not going to have anything to set against the Nigerian tax, and the Nigerian tax man may be happy to see you. And then you've got those who have moved, forgive my train of thought, but I think there's those who've gone to more reasonable countries and more normal countries, and I've talked about what they'll have to do. So a lot of debate, I think, and a lot of confusion, and I predict we'll probably see a bit more tightening of the rules over the next few years as the law gets amended in future, as I think it'll have to be. The other one we've seen related to this is not just for individuals, but for companies they own. And we talked about this at great length yesterday, but let's make some comments on it. If I've got a company in a foreign country and I'm managing it from Nigeria, it is going to be regarded as a Nigerian resident taxpayer company and will be taxed in Nigeria. That's a degree of evidence and degree, but that's what the law says. Is the company effectively managed in Nigeria or centrally managed and controlled in Nigeria? If so, we're going to tax it. If it's owned by a Nigerian company, which perhaps won't apply so much to Nigerian individuals, then it can be treated as a controlled foreign company. But you've got that other piece of law somewhere already that's been carried into the new law, that if you've got a company owned but controlled by 5 or fewer individuals in Nigeria, then it can be deemed to have declared a dividend in certain cases, which will then become taxable in Nigeria in the individual's hands, even if no money has flowed rather. So there's quite a lot of different elements of complexity there, I think.
Yeah, and on that last one as well, there's a difference between if you have got a tax bill arising from a deemed distribution, as against if you'd actually brought in the money through an approved gateway where you're completely tax-free. So one of the possible drivers for that might have been to force more forex back into Nigeria.
Perhaps. Yeah. And on domicile, I just thought to mention an interesting point. Now, the UK has introduced, removed the exemption for non-domiciled people living in the UK, which means that you could end up with taxation in the UK as a non-dom while having domicile in Nigeria, and so you're caught between and betwixt.
That's a very real problem.
And the UK law, what UK is saying is not just your income will be attacking, we'll also be attacking, sales of assets. So if you sell your house in Nigeria, then you might be paying capital gains tax both in Nigeria and the UK. That'd be interesting.
That's interesting. And actually, that's an interesting segue into the new changes to the capital gains rules in Nigeria, where it's now taxed at your marginal rate of tax rather than at a fixed figure, as in the UK, for example. And what we've just been discussing, the interaction with double tax credits. Would you want to expand a little bit more on how these reforms align with international tax practice and what you think would be the outcome on Nigerian taxpayers, forced or normal?
Right.
Go on.
Let me have a go first, Theo. You can correct me and amplify it. I think yes, it's the existing Capital Gains Tax Act is interesting and difficult to construe when it comes to taxing assets outside the country. I think you could read it that for somebody who's ordinarily in Nigeria, it probably taxes their worldwide assets and the disposal of them, but that's not been the practice. Last time I looked at a state income tax return form, which wasn't that long ago, I couldn't even find a place to put report a foreign capital gain. Be that as it may, the law will now be clear. Any asset you've got anywhere in the world, you sell it, you make a gain, we want to tax it. Ignoring the effect of double taxation agreements. What's the most likely effect of that? I think wailing and gnashing of teeth. It's not very nice, especially now it's not at 10%, it's at what your marginal rate is, which could be 25 or somewhere tending towards 25. So that's not great news. The capital gains tax, it's not been very nicely put together in that you get the deduction for original cost if you can find it and prove it, but no inflation allowance, no indexation, no compensation for the time you've held the asset, and no compensation, it appears, for the fact that some of that gain accrued before the change in the law. So there's no rebasing on the 1st of January 26. So it's a little bit harsh and unfair, but that's what it is. That's what we got. So I would think for a lot of individuals, sensible thinking might be, well, how do I make sure I haven't got an asset by the 1st of January 2026? What can I do with it? Can I put it in something else, some other vehicle that's not me? And maybe I'll pay 10% tax on it if that's required under the current law, but at least I won't pay the marginal rate going forward. It's just a possible mitigation approach. or and sticking it into other and putting it into and creating other structures. But the time to do that is fairly short, and time flies on these things. So that's my initial thoughts, Theo. It's probably it's not great news for people. It is going to take a change of approach and understanding.
Yes, it means people will pay more. I agree. I mean, Mark, you were talking about only income tax affecting the more well endowed, but you can see that this will apply, even will apply to them as well. So if you are a high net worth individual, not only would you pay more income tax, then when you sell assets, you're likely to be caused by this as well. The lower income, not high net worth people have an exemption which extends up to 150 million or so. So if you're selling assets worth below that, you don't pay ABCGT. So they will still be fine. But those who are doing things above that, the typical property in Lagos is worth much more than 150 million. So that's something that they will need to worry about. Whether there's an easy answer, I don't know. I mean, it's going to be difficult to say you will quickly sell an asset between now and December, because there are transaction costs, whether it's a consent fee to the government, stamp duty, and all that, which may make it a bit, take away some of the benefits you're trying to, capture. But those are my thoughts.
I think I agree with you on Nigerian assets, and consent fee is a problem, and generally getting it through the bureaucracy. And perhaps I'm thinking more of foreign assets. But
Okay.
I think the other point is there's quite a lot of complexity, as there always is in the capital gains tax legislation. There's an exemption somewhere for private residence, but I think it's once per lifetime. Which is a restriction we haven't got here. We've got a restriction in the UK. There's only one house at the time. You've got to decide which one it is. And then there's got to be some evidence of it. And South Africa similarly. So you've got that one. You've got another exemption for certain motor vehicles, probably because they didn't want people creating losses. And for household chattels, similarly, because not many of us buy furniture which goes up in value.
Yeah. I mean, cars hardly ever go up in value, cars.
And it can do in Naira sometimes.
In Naira, yeah.
There are a couple of mindset changes with the assets that are now caught by capital gains tax that individuals are going to have to start thinking about. One is that if you sell more than 2 cars in a year, you are chargeable. And depending on, and no matter how decrepit your car is, you hang on to it because of exchange rates and various other things. They tend to go up, at least in Naira value, year on year. So there will be those sorts of chattels that are now coming on. Of course, if you are now involved in the cryptocurrency and digital space, these are the gains on those ones now come into play. And so there's a lot of mind shifting, I think, that Nigerian taxpayers, and I use compulsory or non-compulsory advisedly, but Nigerian taxpayers need to start thinking through, because they will crystallize gains that are probably not expected.
I think that's true, Mark. And I think just adding to that, one of the behavioural responses we see in the UK to capital gains tax on property or any other property tax, like your stamp duty transaction tax in the UK on selling a house, is that people don't sell. It gums up the market, and people would rather say, I'm not going to sell, I'm not going to pay that much tax, I'll just put up with the house. I think there's an element of that will happen. On the crypto, I think it probably always was, but I think what this law does now is gives a greater emphasis that all these things come into the tax net. Just noticing the reports yesterday and today, South African Revenue Service taking action against social media influencers and reminding them all the money they make, even if it's non-cash, is taxable. And conceptually, that's a position that holds in Nigeria as well. And looking at the chat box, somebody asked a question, how is it going to be enforced? And I think that perhaps a good time to deal with that question. I think all tax relies on self-disclosure. You understand your facts, you understand what you've done, you understand what, as best you can, what the law says, and you go and put a tax return in accordingly. And the tax authority that don't like it will tell you why. If you don't do it, they may fine you. And traditionally, I think Nigerians tended to assume that they wouldn't get caught, which is a good thing to think if it's true, but I think increasingly the tax authority is likely to find it. You know, one of the things that went down badly with somebody was some legislation in the tax reform laws about virtual asset service providers and the tax returns they're going to provide and who's going to be regulating them, and a huge amount of returns, including information on all their transactions. So I think it raises the detection risk quite significantly. And there's some other law, which we're going to talk about later on penalties being increased. And that's, again, a mindset shift perhaps required from the administrators, the tax administrations. But over a period of time, I think higher rate of detection, higher rate of being told you have to pay, and higher set of consequences from doing so.
Yeah, and to add to that, Russell, people forget that in the old law, well, the outgoing law, there was a provision that gave the FRS power to access bank statements, and it's been retained in the new law. Yeah. And using this power a few years ago, Fowler, who was then chairman, simply plugged into the banking system, and he could see everybody's accounts. And they started writing letters to people saying, "Well, we see that your turnover for the year was 5 billion. You didn't report it, so what's going on?" They went a bit further and asked some banks to block the accounts, which the courts eventually said was illegal. But the power to access the accounts is still there. And so, talking about the detection, there's an easy way they can do that. They simply plug in like a bank into the system, and they can see everybody's accounts.
Yeah, there's some interesting things there as well, encouraging more cooperation between the state revenue services and indeed the joint board to share intelligence and share ability to do the work. So if Lagos has got infrastructure and Gombe State, random example, has, then they can ask Lagos to help them.
Indeed. And in fact, the fact is that with the emphasis on digital tools, digitization, and the help of my good old friend AI to quickly analyze and spot trends in such information, I do think that the revenue authorities, provided they've got a proper risk analysis template and a strategic risk to compliance approach, they will be able to identify and make example of a few good cases. If they are ready to do that, that will drive generally compliance across the piece. And one of the ways...
Let me share a funny story from many years ago when South Africa had a problem with individuals who wouldn't file the returns on time. What they started doing then, they suddenly noticed that that's an offence. So what they did, Friday afternoon about 3 o'clock, they'd arrest you. And you'd spend 3 nights in the local police station's cell until you could get bail on Monday. And compliance rate went up quite fast. Because we don't want to send 3 nights and a weekend in a South African police station cell. Now, I'm not saying Nigeria is going to do that, but I think they will over a period get more used to the powers they've got and a bit braver about using them.
Yeah, indeed. Already, I think yesterday we gave the example of Lagos State. You exceed your day for making your return by 1 day. They immediately apply penalties.
Oh, yes.
I remember when I was in HMRC in debt management, the minute you crossed it, especially if you were a very large person, I'd send you a potential letter of winding up a day after you had failed to pay over a few £100 million. And that could unwind your entire mezzanine loan structure of a large corporate. So it does drive compliant behavior when there are consequences. And I think that what is really going to be the test here comes back to the question that somebody asked in the room: how will it be enforced? If it's not seen to be enforced, it will be as effective as the VADES program was. If it is enforced, you will see a step change. And to the question about how is it actually going to be reinforced, there's a benefit, but with a sting in the tail. That is the tax relief for rent paid by individuals, which increases the level of exempt income that they have before they have to start paying tax. So there are certain specific changes, and this is significant. But the other side of that is it could well be the Trojan horse for collecting information, because for you to get that rent relief, you have to rat on your landlord. You have to give his details, how much you've paid and everything else. And so the revenue authorities, if they put their act together, will be able to start pulling this information, tracking those properties, and they've got evidence that you own it. So no matter how you pass it through various nominees, I've got a lot more information about who you are and what you're doing. And if that rental income stops, it tells me that a disposal has been made. But this could have an impact on the entire real sector, property. A lot of gray money in Nigeria is hidden in property. What do you think are the advantages of that approach and possible drawbacks?
Yeah, Mark, I think there's a maximum of 500,000 for that relief.
Yes, that's for the relief. But people will generally put in, including those high net worth individuals, give me the 500,000, even though I've paid 20 million, because there's a limit on it.
Yeah, so you can't get relief for more than 500,000. So if I'm a landlord and you're paying me 20 million, I'll say, well, okay, I'll give you a 500,000 discount. Just don't tell the revenue.
But wouldn't you have to disclose that under the new rules that say that you have engaged in an activity designed to reduce your tax exposure? So the rules are.
No. You're
right
supposed
to
claiming the relief. You're not obliged to claim a relief. So you have not done anything. You're not obliged to claim a relief. So landlord says to you, well, don't claim the relief, and I'll give you a discount. So don't claim the relief. The law doesn't say you must report. The law says you can claim a relief.
Yes, and you've been induced to.
Yeah. So it's. But I can see things like that happening. The relief isn't big enough for that level. Outside of Lagos, maybe it's big enough, but in Lagos, 500,000 is nothing. So I don't know how effective it'll be. But I take your point that it means that Lagos State or whichever state government will be able to track landlords and then collect both the tax on that rent received and also the stamp duty, on the rent. Although when we come to stamp duty, we can see that there's for rent below 10 million, there's no stamping to be done, but that's a different point.
Yeah, absolutely. Okay, so as we're talking through these ones, we've spoken about Nigerians who are non-resident under existing rules, but will become resident under the new rules. We're talking about expatriates who would have used their in-out provisions to have been escaping tax before. We will have those who are outside but own properties inside the country coming into place. And we also have in the administration law the requirement to disclose any scheme that you have participated in that reduces your exposure to tax. Have I over-interpreted the fact that almost anything that anybody's doing would have to be reportable at some stage or the other? And I contrast this with recent news, I think in the last 1 week, that HMRC has specifically named 5 or 10 accountancy firms that have been actively selling avoidance schemes. Put that together with the fact that tax advisors need to be accredited. How is that going to change the landscape and the ability to move around things?
Yeah, I think it'll be it's a journey. I think it's setting a stick in the ground, saying we want people to start doing these things, and over a period of time it'll happen. And take different parts of it. Not every transaction you enter into is going to have to be disclosed, but it says a disclosable transaction, one that is the principal purpose of which is to secure a tax benefit or would be expected to be, and that's a bit judgmental. And you may. Certainly they're better off, even for companies, it may be better to err on the side of caution so you don't get penalised for not having disclosed. And then, perhaps to some extent you bury the tax authority in information. That's because they're going to have to work out what to do with all of this. The second then is, once you've disclosed it, what they're going to do about it. If it's an off-the-shelf scheme like those umbrella employment schemes in the UK, then they'll counter it by telling you this doesn't work, we're going to come after you for the pay as you earn, and we'll go and close those companies down. Equivalent in Nigeria might be similar. And there's powers there that's called about prohibited tax schemes, I think. Essentially, doesn't mean they say they're prohibited. They're not going to as such, because but what they will do is they'll assess as if it didn't happen.
Right. Back to that.
Yeah, I think it's going to be a lot of work for the tax authorities, and I suppose they'll try and pick on the more valuable or important ones. So I think, I'm the accredited tax agents one. I think that's going to be a matter of some contention. I think it always has been, but already has been, between FIRS and other tax authorities on the one hand and the professional bodies on the other. But I think it does give them a scope which they've wanted for a while, which the UK has, to get people struck off the ability or removed from the ability to correspond with the tax authority if they are essentially being disreputable. And we had that in the UK, Mark, many years ago, and we did see people, even as certified or chartered accountants, being told they could no longer correspond with the HMRC. Over a period, it should help improve professionalisation and cut out some of the less reputable behaviours. I think it does put an onus on CITN and the other professional organisations that do an awful lot of training effort, and to credit, the CITN has been trying. But I think it's not going to stop now. 300 pages of law you don't learn overnight.
Absolutely. Theo, any further comments on that?
Well, not much. I was just wondering whether they will go so far as to say, if you are struck off as an accredited tax agent, does that mean you cannot appear before the TAT? Because that would take it a step further. You see, because corresponding with FRS, some companies do it themselves. You draft it for them and they put it on their header paper and they send it off. But but if they now say, in addition, you can't appear for the client before the TAT, then that would give it a bit more teeth.
Absolutely, again, and along with the sort of administrative changes with higher penalties for non-disclosure we've been speaking about, but other penalties for not doing certain things, and the introduction of a single tax ID that covers all sorts of taxes across the country. There's been quite a bit of controversy over the single tax ID and bank accounts. And some people have interpreted it very widely. FIRS has had to come out, the chairman himself, and make a statement that you do not necessarily have to have a tax ID if you are not in business. But that would be if you not have a business account. I don't think we've quite got to the bottom yet of what the circumstances exactly that refer to a tax ID and the practicalities behind reconciling tax IDs that have been held across a number of different systems. Any thoughts on how this has been given to the Joint Tax Board to sort of coordinate under their own new act? But are there any thoughts of what taxpayers, individuals should bear in mind?
I would say, perhaps some ideas. I think it's a good direction of travel again, and I think a single ID and not having to register every state and other things is probably a good thing. It's going to take some time to get there. There's been some commentary. How are you going to crunch all this together between now and January? I think various people have made the comment it'd be sensible to use the BVN as far as if people have one, and I think that is sensible, or the NIN. And my last experience of the NIN was I couldn't get one when I was living in Nigeria. I think that may change. Gap between the law and the practice. So those are sensible things, but it's going to take some time to do it. And in the meantime, they've got to get to a position of the law. I can't see by the 1st of January them being able to crunch all these things together. I think comments have come from both Taiwo and the chairman of FRS that they want to integrate with the BVN system. But again, I don't think it's not a 10-second job.
Now, alongside these there is the tendency to come to agreements with the revenue authorities over how much tax I'm actually going to pay. Some of it bordering on a commission. I'm being polite in my choice of words here, but there is specifically a whole set of new rules that just simply make completely clear that bribery and bribing officers will carry a penalty for both the person who offers and this, especially for the tax official who does breach the rules. How far do you think that is a change, if it is, or is it just simply a visibility issue?
Well, I would say that bribery has always been an offense, like I said yesterday. So I agree with that. It may be more about visibility. There are laws about bribing public officers in various pieces of legislation you will find. Now, the ability to compromise a tax assessment or liability has always also been there, and the two don't have to be connected. It doesn't follow that because the authority or the revenue has agreed to revise, the amount, that there has been a bribe. In fact, the chairman right now of the FRS has a committee called the Settlement Committee, whose job is exactly that. They look at a proposal to settle, and they say, okay, you assessed 30 million, you're proposing 15 million for the following reasons. Okay, we'll take 20. And this committee has the head of legal in the FRS, some of the top executives, about a dozen of them. They sit around the table with the taxpayer and reach a number. This provision, I think, I would say, is just for visibility rather than creating something new. Okay.
I think it's one of those things. If you stick it in the law and make it obvious, then it perhaps encourages the people to realise what is not and what is not acceptable. And I think it's interesting they put it both for the person paying or trying to pay or offering to pay, and for the recipient. It's a fairly broadly defined thing for the tax official. Behaviours that are not acceptable. So it's probably useful to stick it down in paper, but I agree, it's not really changing the law. It stipulates the penalty. It's a potential jail term, which people may want to bear in mind the rules of them getting American visas. And it may, over time, change behaviour. I think it's one of those things that will change behaviour more if it's enforced than if it's just left to go rusty on the shelf of the other statutes. The settlement procedure, again, the FIS is doing it, but an awful lot of others have not been. They've been formalising their approach. I think some of what we're seeing in the NTAA is taking the formalised FIRS approach and codifying it. So the settlement has to be more written down with some justification for it and what have you. So it's trying to formalise and professionalise what perhaps was happening. But I think the old days of suggesting to the taxman in your local state revenue what he should accept as your revenue for your income for the year and give you a tax clearance certificate in that number when it's got no factual basis may be harder.
Actually, there is now a provision properly stated for compounding provisions in order to avoid going down the legal route for a penalty, but still paying part of the penalty. So it's allowing common sense rules with an element of recording to operate that drives more revenue for the system. So years ago, again, in HMRC, we codified taxpayers. We arranged them from those willing to pay and able to pay, through those willing to pay but unable to pay, needs help, through to those who would take chances and therefore you did random audits and so on, right through to the ones who just stick their fingers up at you and say, I am not engaging. And this whole process, alongside a compliance risk management strategy that is well informed, would allow appropriate action to be taken against a few rather than the current sheep dip approach, where those who are slightly compliant are washed every 2 weeks and those who don't want to take a bath at all completely stay out of the sheep dip. Is that a fair assessment?
I think it is. I think related to that, the penalties are increasing. I think I said yesterday, the current law says if I'm caught not paying enough tax, I haven't declared it properly, what's my penalty? Bit for late return, 10% of the tax. Maybe I think I'm not likely to get caught. Secondly, I may induce the tax official to turn his eyes the other way. If I had to pay 10% penalty, now it's going to be a 50% penalty, and the tax official maybe have his own risk assessment of whether he wants to cooperate with you. For want of a better phrase, and how is he going to sell it to his bosses? So the risks and the potential downsides have certainly gone up significantly, I think, under the new law. Okay. And that's but penalties is one of those things where it's important to work out just when does the NTA take effect. It's all right and good for Taiwo and Zakadeji going around and saying it's 1st of Jan 2026, but in 3 years' time, nobody will remember who they are, what they said, and it's not what the law says.
Yeah,
absolutely. Absolutely. Yeah. Now, just before I go on to ask another question on a slightly different tack, we have a question in the chat room that's with regards to rental relief. How are employees supposed to share these details? Would they be integrated into the payroll system? Without giving my own view, which I think I know, do you want to make some comments on that?
Well, there is a form which you fill out every year. At least Lagos State does that. I don't know about many of the other states. So even though you're an employee, you must fill this form because you may have income which is outside of your employment income, and so Lagos State wants to know. And in that form, there's some provision. There's reference to rent and things like that. So I believe that's where things like that will come in. Now, maybe the question here is, would it be factored in calculating your monthly deductions? That's a different question. And I suppose depending on the time of the year when the rent comes in, it may or may not be. I mean, if you got it at the beginning of the year, then it could be. But if it's middle of the year that you got you paid rent, then maybe you get the relief towards at the end of the year. Those are my thoughts.
Okay. My comment is probably a hands up, and a couple and say, look, I've not read the mechanics of it carefully enough. I know the relief is there. Whether it can come into a declaration to your employer on a form during the course of the year to reduce the pay as you earn, like the pension relief or whatever, and the life insurance did at one stage. I'm not sure. Or whether you have to wait till you fill your annual tax return in and reduce your bill and hopefully get a refund. I can't recall, but that's something we can look at.
I guess that's something that both the FIRS, in fact, the Joint Tax Board for all the states, will be providing guidance and instructions on these sorts of things. One thing is very clear, which a lot of people, including very, very highly placed individuals, even in government, who earn a salary, then say, I've paid tax and that's my tax and I got my tax clearance certificate. No, you haven't. You are now required, regardless of whether you have your tax deducted at source, to make an annual return. Everybody's required to do that. Now, that is a significant change because it's now very, very explicit in the law that you must make a tax return, even though it was implied in any system before. So that would, allow you to disclose certain items, your capital gains twice a year. There's a specific form for doing that as well. 150 million in sales or 10 million in clear profit for the capital gains to kick in. So the question really is going to be how the revenue authorities take on board the rules, the law that they have, in order to be able to apply it, but more importantly, how they're able to scan what is going to be a massive amount of information for a limited number of staff. Russell, when you and I were in HMRC, we were talking of tens of thousands of staff. I'm not sure if you added up the entire staff, including FIRS and all the 37 states, you'd approach a figure anywhere near to what one one division, compliance division in HMRC had in terms of staffing. So you're going to have to use increased risk management. You're going to have to use digitization. You're going to have to use analysis. But the primary tools, to my mind, are in place. They will need guidance and they will need some enforcement, but they are there. Now, I'm conscious of the time, and I'd remind people to drop any questions they have in the chat box so that we can deal with them while we still have a chance. But one of the things that has stirred a lot of discussion is the favorite subject of VAT. And the changes on VAT and the fact that everybody thinks that they're caught by VAT and so on and so forth. So how would the recent changes in the VAT regulations affect individual taxpayers? For example, in terms of any compliance they have to undertake or any financial planning that they have to undertake. Both the exemptions, I think Theo mentioned the fact that VAT is now explicitly not on rental income below certain amounts, and so on and so forth.
Yeah, I think there we go. VAT on rental was subject of a tussle, I think, between the states and the federation a while back, and land is generally seen as a state issue. They're the ones who tax land. So that one, I think, was FIS reluctantly accepted the position, and so did the federal government. So that one's good. I think the overall view I've got on the VAT changes is it's a very good thing. It's a good thing for companies and it's a good thing for individuals. Why? Because it takes out this cascading effect that led to price increases. Because people selling you things couldn't claim the input tax unless they were buying and selling that thing or manufacturing it, but all their overhead, etc., they couldn't claim. So it pushed up their cost base. That pushed up the prices they need to charge. I'm not going to promise that prices will come down because that's going to be sticky, but maybe they'll go up by less. It perhaps increases the chance of competition pushing prices down, but it certainly makes for a fairer thing. Now, the average man in the street is not going to be able to go and register for VAT because he's not running a business. And if he is running a business, hopefully he'll fit in the small person category. Just on that, I did notice that a small business cannot be a professional services firm. They're all not a small business. They'll always have to charge that. I think those who go above the threshold, who are running a business of some kind, will have to comply, which means registering. It means getting a system for producing your tax invoices, recording your output tax, identifying what input tax you can claim, and going off and doing so, and keeping the documentary evidence required. So it becomes a bit of a chore, but it's probably a beneficial one in that it can secure you some reduction in the tax you're paying. So yeah, my overall thinking it's a good thing, but it does professionalize and bring more complication and bureaucracy to the whole system.
Theo?
Yeah, well, I agree. There's more bureaucracy, but that's always the case with all taxes, and sometimes you need to balance the cost of enforcement and collection with the cost to the taxpayer, who has to, comply. So you might find that, the compliance cost might outweigh the amount that, revenue seeking to collect. From a broader perspective, if you look at the economy as a whole, if like Lagos State has what's it called, a levy, 100 naira levy that they've had forever, and they collect from every individual, and you wonder, is it worth trying to collect? Because
Adam Smith groups is not
yeah,
worth the.
Yeah, so it's something they'll have to think about. Many of these things are nice on paper, but if you're going to spend more to collect than what is being collected, or if the taxpayer is going to incur a bigger expense to pay you that money, because to pay that 100 naira, I need to go to the bank or I need to go to Lagos State's office. That's going to cost me more than 100 naira. So I'm more likely to say, look, I will pay. So those are things that need to be borne in mind. It's one thing to put it in the law. It's one thing to see whether it really is really effective from a broader economic point of view.
Okay. On
I
that
think
broader,
on that one, just commenting on that, I think that 100 naira is a nuisance tax, and I think it's probably not the job of the federal government to tell Lagos to drop it, but they should get there themselves. I think the stamp duty reforms are probably an example of a missed opportunity in this law, in that they've done some simplification, but an awful lot of non-simplification, and there's quite a lot of nuisance stamp duties left in there. Not the ad valorem ones, a percentage of an amount of money, but the fixed amounts, 50 naira, 150 naira, whatever it is for this and that. And really, what's the point? I'm not sure what happened. I suspect somebody objected and wouldn't let the committee take it off, but and there's a bit of a trade-off. But hopefully over time we'll get to a more sensible position of let's have taxes that are worth having, worth collecting, and worth everybody paying.
Yeah, indeed. There's talk by the committee of some follow-up legislation and or regulations around harmonization to reduce the plethora of taxes that may help convince some states to drop nuisance taxes. When you align that with the requirement to very overtly and clearly make a tax return, some of the arguments that this gave you your finger of who the taxpayers were becomes less and less important because you're getting your information in other ways. With the stamp duties, now that you have mentioned that, there are some, and I can't remember whether it's in the final version or one of the purported circulated versions before. I think there were up to 3 different ones that were in circulation before, that if you don't pay stamp duty, your courts will not recognize, say, your tenancy agreement, or it won't be discoverable in a court of law. Theo, this is your area.
Well, that has always been the case, even under existing law. If a document is not should be stamped and wasn't stamped, you couldn't tender it in evidence. That was the penalty. But so many people took the view, well, I'm never going to need this document, in court, so I would, wouldn't bother. So that was the only penalty. So if it's a 1-year lease agreement, I've paid rent, I'm in occupation for 1 year, why should I bother? But it meant the government was losing that revenue. So it's not a new provision. Let me put it that way.
Okay. I think that's fine, and it can be remedied the same way as ever. You when you want to use a document, you run down to the local stamp office with the document and the money, and you pay a penalty on it. But it's not the end of the world. I think you mentioned the rents, and excluding the low value rents of certain types of property, the rent is still very much there in the stamp duty schedule, and it's a lot clearer than it was, I think. Even I can understand it now. So I think I would predict we'll see an enhanced enforcement effort on the stamp duty on rental agreements. What I did notice is they've changed a few times during the course of the legislation's development. Still seem to be back to no stamp duty on share transfers, which is probably welcome.
Yeah. And regarding stamp duty enforcement, I noticed that a few years ago, the FRS started asking questions about that when it audits the companies. So when it's auditing a company, not only does it ask about expenses and revenues, it's asking, well, you have this service agreement with this supplier. Is the agreement stamped?
Right.
And so that was one way to generate that sort of revenue, because they weren't asking those questions before, but they would know there was an agreement, but they wouldn't bother. But now they were saying, okay, so this payment is for this supply, and so there's a supply agreement. Where is the document stamped? And sometimes those documents have numbers, values of in the millions, and so the stamp duty is significant.
Yeah. No, I hear you. And I think one of the dangers of a big bang approach is that because everybody's got to go off and read the law and learn it, they will, and they'll see everything in it. And whilst an incremental approach, they may not have gone back to some of the older dangerous provisions. So I think we will see more interesting questions coming out of the tax authorities, unfortunately.
Okay, so what we've covered so far is the impact on the different income groups, the fact that higher net worth individuals will pay slightly more in direct income tax, but will have more exposure for things like capital gains tax. Hinwis are likely to be the ones who have homes at home and abroad, to use the the favorite term, who may now find that they are taxable. And while we're thinking about home and abroad in terms of Nigeria on and offshore, we can also think of this in terms of the rights to tax by different state authorities, subject to the tiebreakers that Joint Tax Board has over which state you're resident in. So you'll find some taxpayers. I know there was a time before Lagos stepped up its game, where a lot of traders making large sums of money in Lagos went and registered for their driving license in their home state that was unlikely to ever say anything at all to them. These are specific examples because somehow, somewhere at the back of my heart, I remain a tax inspector at heart. And so I'm always looking out for these kind of stories. Those sort of situations are less likely to occur under these new rules. Is that a fair assumption to say? Where you will get caught, you will get caught.
If there's cooperation between the states, I mean, they have to work together. The data is there, but if they're not sharing and talking to each other, then it may still be possible to slip between the cracks.
Right. That's absolutely fine. Just half a second. I was going back through.
Oh, Russell has disappeared, I think.
Oh dear. We'll give him half a minute to get back in. While we're doing that one, we've sort of spoken about the administrative changes, the higher penalties, and the need to avoid those higher penalties by playing the game. The single tax ID, and that's going to be very important for high net worth individuals who are members of different partnerships, for example. Yes. Because at the moment, I find that a lot of states want you to have a TIN number for your partnership, which is just a business name, not even a company, as against a TIN number for you as an individual. So the rules about taxing partnerships and how profits are allocated and what happens do need to be explained a lot more to both officials and taxpayers as well. We've spoken about the recent VAT changes. The kind of advantages that it would have for individuals are, for instance, something like if you produce your nappies or sanitary towels in Nigeria, those businesses will become more competitive, hopefully again driving down some of the prices. The fact that some individuals who are aggregators of crops, say for rice or for yams, can get some VAT back if they've had to pay VAT on fuel for transport or various other things, but those are more into the business rather than as individuals. But overall, it should see an improvement in the environment. I think the big issue for a lot of Nigerians who want to japa or who have japat, or in my own time, when I went out, it was doing an Andrew, but Andrew did come back.
Yes, he did.
It is now that on top of all the other things you're thinking about, you've also got to think about the tax and the potential implications of posting on Instagram that you're now earning millions.
Yes.
So we have filled our time. I've just got another couple of questions. If you live abroad and have some property you rent out in Nigeria, are you required to complete an annual return?
Well, you are taxable. That rent is taxable in Nigeria, certainly. It would be, yes, the return would not be one for employment, because there's a return for employees, there's one for people who are not employees. So you wouldn't be classified as an employee. So you do a return and mention the rent, but that'll be it, and pay the tax.
Okay. And then also another question. Are you okay, Russell?
Yeah, I was going to say, I think that's okay as long as you're not within the definition of a person resident in Nigeria, as we discussed earlier. There is an exception somewhere for people who don't have to do returns, I think, for those whose income is subject to final withholding tax. But that needs some fairly careful plotting through what is final and what's not.
Yeah, for rent, I don't know if that rent is it a final withholding tax? Well, I suppose
I
it's
can't recall.
yeah.
I don't believe it. I don't believe it is a final tax. It's the withholding tax is on account of your final tax bill.
Yeah, no, for some in some cases, especially if you're a foreigner, it can be a final tax. But yeah, I take your point. Yeah, it's something worth looking at. Yeah.
So there's
and then of course you may also have to file a return overseas. That's the other niggle with this.
Yeah. As a UK non-dom.
Yeah.
There we go.
And that gets complex.
Also, I remember there was a case of a lady in Germany years and years ago who had left the United States for over 20 years, but they still caught her for all of the tax that she paid in Germany. She should have paid in the US. So there are going to be peculiar relationships between the application of the US laws and the Nigerian laws, because you cannot, it takes more than 10 years to lose your residency for US purposes, and if you haven't made certain declarations, it stays with you for life. So again, all those firing off need to be aware of that. Okay. We've got a couple more questions. How would a lawyer who is a director in a small company and a consultant to another company go about his tax and compliance obligations? It's a very basic question, but do you want to give a very basic answer?
Yeah, I mean, if you have a director's fee that you earn, you put it in the form in the annual, your annual return. If you have a consulting income, you put that. So the form requires you to put all your income.
Yes.
So that it's as simple as that. Whatever the income is. If there's rent, you put it in. Whatever it is. Yeah.
Yeah. The current form
is put it on your annual tax return.
Yes.
I was going to say, you put in a tax return, you should have suffered some withholding tax on the consulting fees, and you'll put that in there as well with the right evidence, and that got a bit easier with the withholding tax regs. So yeah, you declared it all.
Well, with regard to withholding tax, you would declare the full income in your return, but then when it's time to pay the tax, if you've got the withholding tax receipt, you can use that as a credit.
Yep, that's what I meant.
Yeah, you can do that. And also, depending upon the nature of your consultancy, you may have expenses, such as your own back office, your personal rent, those other things to set against it. So people do need to remember there's a difference between your taxable income and your gross income.
Yeah, correct.
I remember again when I was in the UK, lots of friends used to come up to me and say, I've got a buy-to-let property. And I now want to regularize my stay in the UK, and I'm renting it out at 12,000 per year. I can't afford to pay 4,000 at the 40% tax rate. And I'd say, well, first of all, in law, you're allowed a deduction for the interest on the rent you're paying on that property. You're allowed a 10% wear and tear of the difference between rent and rates, and so on and so forth. So you would never be charged to tax on the full 12,000. It would be on a profit element. Remember, a lot of people forget that, and including tax officials, forget that tax is not based on turnover other than taxes that are tied to turnover, such as VAT or some of the levies. Tax is based on your assessable profit. So those are some of the basic things that people still
Mark, I was going for a slightly specious answer to the question, and it's not self-interest because I don't provide compliance services. I think the first thing is go and find yourself a tax consultant to help you for the return.
I did forbear from saying you need need the tax here. That's why I said it was a very basic one.
There's no offence to it. I hire a tax consultant for my own tax affairs in the UK.
So do I.
I can't understand their system.
They're more objective. Could you please elaborate on the new tax bans and the tax reliefs that an individual or employee is entitled to? Those are clearly laid out in the schedule to the law. Is there anything else any of you want to add?
No, they are laid out. I think I can't remember them all. What I have said, could say, first stage under 1,000 is 0% tax.
Yep.
And that remains. Everybody gets that. So you don't get the 21 or 20% of your income before you get 800,000 naira. It then goes up in stages, and I can't remember where it gets to, but eventually it gets to 25%, I think, at 50 million.
25 is at 50 million.
And roughly speaking, and I think Taiwo's figures more or less agreed with mine, somewhere just above 18 million, you'll start paying more tax than now because the way the bands fit together. But yeah, it's in the schedule. One of the things I'm hoping for, because at the moment, as you say, we're all running around looking at the hard copy or whatever we've managed to get off the website. I'm hoping that people will produce a nice bound together version of the two main acts rather, NTA and NTAA. Hoping and praying for PwC to stick it on their Tax 24/7 app soon, and hopefully somebody will publish a hard copy book so I can all look at the thing much more easily than currently. Because as you said earlier, we now have to remember a whole pile of new section numbers scattered across these 308 pages of legislation.
Yes, indeed. And the administrative rules regarding personal and company income tax are in the NTAA, but the fundamental rules about the taxing of those ones are in the NTA, and so on and so forth. As I said, it's going to be a complete unlearning and relearning of what are essentially things that still remain fundamentally the same, but are approached completely differently. So just before
Sorry, Mark, there's one more thing I think I did want us to emphasize, because I don't think we did it earlier. We talked about taxing of foreign income. There are cases where there's an exemption. Ignore the one on exporting of goods and services, because that's more a company thing. But if you bring foreign passive income into Nigeria through official channels, then it becomes exempt. That was a fairly late stage change, so that's worth remembering. And that's why you got that problem. If you've got a deemed dividend, it'll be taxable, and there'll be no foreign taxes to set against it either. If you actually bring it back into the country, into your DOM account, then it should be exempt, and you'll get a credit. You won't get credit then because it's exempt. You won't get a credit for the foreign taxes. The question in my mind is, you bring it back, how long does it have to stay in Nigeria? And that may be one of the planning points that people need to think about. And I haven't got the answer because it depends on how the central bank will let you take it out again, and how generous they're feeling in interpreting the exchange control regulations.
Yeah, there is a lot of regulations and guidance notes that I know that FIRS is currently working very hard on in my various other interactions with them, and I think it's worthwhile. Anybody who has a reasonable amount of tax to pay should either get an advisor, or if you're an advisor, keep a very close eye on what the explanations are coming out for some of these items, so that we provide proper advice as you go through. At this point, we're sort of coming towards the end. Is there anything specific you want to address, and what would be your parting thoughts? Shall we start with you, Russell?
Yeah, I don't think I've got any further points. I just took the opportunity to do that. But I think my final comment is, it's a whole new tax world, a lot more complicated law, a lot more things brought into the scope of it. And it's the time, I think, to sit back and look at your affairs, especially if you're one of the better off. Look at your affairs and think, well, what's the impact on me? And what can I do about it? What do I need to disclose? What can I change? How can I mitigate the effects? And that may be a bit of an iterative process as we get to understand the law better, but that'd be a good starting point. That's my main thing.
And Theo?
Well, I'll just put it in a couple of sentences. Just get yourself a good tax advisor, tax consultant, because there's a lot to talk about, and we can't do that in 2 minutes. But if you get yourself, like the chap who asked whether he'll have to pay tax if he has rent, and is living abroad, just get a consultant. I don't think, you can do worse than that.
Absolutely, especially with the penalties if you do make a mistake.
Yeah, exactly.
And I still haven't seen any error or mistake provision in the new acts, which there used to be that you could say up to 6 years later, oh, I made a mistake. I haven't seen that yet. Perhaps it's because I haven't studied it well enough. But thank you
I
very
looked hard,
much.
Mark. I couldn't find it either.
This is what they call a strict liability offense. If you remember what those were.
Just on that, there's one final.
Yeah, go on.
It used to be, unless you committed or serious neglect, you had a 6-year cutoff after your return was filed. After that, you were safe from the taxman. Now you're not. And I think you're going to start seeing a flurry of letters from tax authorities just before 6 years comes up. Oh, we've decided to investigate your affairs, and that way they keep their ability to assess you open forever.
Yeah.
Okay. Yeah. So there are a lot of things.
But there you go.
There are a lot of things to bear in mind. If you are at the bottom end of the spectrum, life may be a lot easier for you. If you are with a foot in different economies, you may get caught by both taxmen. And when you have a lot of money, you also need to take precautions to use the legislation to help you minimize the tax, or to get the correct rather than minimize is the choice of words. To pay the correct amount of tax, because the minute you say minimize, with my tax inspector hat on, I will say, you've done some planning. So can you tell me what exactly you did to minimize your tax? With those passing thoughts, thank you very much, both of you, for what's been an illuminating conversation. A reminder to those who are on board, the slide sets will be sent out to all of you who are registered. And of course, you've got Theo's and Russell's contacts at the back of the slide set, so you can come back for more specific information as you need to. With those few words, thank you very much for taking out the time to engage with us.
We got
somebody's got a
hand raised.
Yes. So can we allow her on mute, please?
Yes, please.
Or him? In SAN?
Yeah, Maya, the lady.
I thought as much, but I've learned never to make assumptions.
Hello?
Yeah, Maya, go on. Yeah, go on.
No, I think I was trying to clap, but I raised my hand. My apologies.
Okay. So welcome to the club.
Thank you.
I thought perhaps you're going to consult me later on, Maya. I'll give you a discount. As a professional.
As they say, I'll keep it in view.
And remember, if you provide a discount, there's a change in VAT, and remember to do it at the right point in time. Otherwise, you enter 101 other points. Now, this is the real impact of the new act. Thank you very much, Russell. Thank you very much, Theo, for a very illuminating conversation. Thank you to all of you who have been on board throughout the event, listening to us, and also providing your own important input as listening to us. And thank you to the admin team in Regan Van Rooy. Regan, I'll get this right.
I'll tell you the background to the name sometime, Theo. It's complicated. It's Anglo-South Irish and South African. But I'll just have my thanks. Thank you, Theo. Thank you, Mark, for moderating and guiding the conversation, and thank you, audience, for coming and listening to us, and really join on the road of getting to grips with this new law.
Thank you.
Thank you.
Bye.